I think we are pretty much everyone's here for today's session. So yeah, without further ado, let's begin. Hi everyone, my name is Don. Today we will be talking a little bit about mastering the US dollar index. Pretty relevant in today's time, given how volatile the market has been, how volatile your politics has been as well, and how that eventually affects the reserve currency of the world. So today we will be talking a little bit more about that. So again, as always, we have with disclaimers to do understand that trading derivatives does carry significant risk. It's not suitable for all investors, and do understand the risk that you taking on if you are trading derivatives on a retail basis, a retail investor. Do understand the risks surrounding that. So I'm just going to leave this disclaimer on the screen for just a little bit before we begin. And yeah, with that also, before we start for today's session, Vantage team does want us to let you guys know that they are running a deposit bonus and deposit promotion. So this is essentially what they have here for you guys. And if you are interested, do take note, you do have to open a live account with Vantage to opt into the promotion, make a deposit, and then claim the deposit promotion bonus from there. You can scan the QR code that is on your screen right now. Otherwise, you can also visit vantagemarkets.com, select the deposit bonus promotion, make your deposit, and then you can claim your bonus to your account from there. But yeah, as I mentioned earlier, this does require you to open a live account with Vantage, and this may not be suitable for everyone, especially those that are relatively inexperienced to the markets and to retail trading in general. I always recommend, of course, if it's something that you're not very used to, you're not very, um, it's not something that you're experienced in, you're just starting out on your trading journey, do always consider starting a um, with a paper trading account, a virtual trading account, where you're not risking any of your actual capital. With that, you can practice, get familiar with the platform. You can even run some of the strategies that you're interested in running in live markets in a virtual setting with a paper trading account. And then once you are ready, then that's where you are able to you understand the risk that comes with it. You're ready to take on live trading and live retail trading by yourself. Then that's when you can move on to a live trading account. But I would always recommend starting out with um, a virtual trading account. And I think that that's probably the most prudent way to go about starting a journey, right? So I'm just going to leave that again on your screen for just a little bit before we start with today's session. And yeah, I think we can start. For today's session, we will be talking about the US dollar index. So, what the USD is, which is commonly denoted as DXY, fundamentals and Fed's influence on the US dollar, what drives that from a fundamental basis. After that, we'll talk a little bit about price action and Fibonacci constants. These are concepts that they can be widely applied and don't have to be used for the DXY, but certainly in a market as liquid as that for the reserve currency of the world can definitely be useful. Technical analysis is something that you are interested in and you would like to use, that is definitely one area that you can look at. And then finally, we'll end off with a live analysis session. So we'll move a little bit to DXY. I'll talk through a little bit about how how the environment has been like, how that's reflected on the charts, and use a little bit of the concepts of technical analysis right there. So it's just sort of a little bit of a primer on the US dollar and the DXY and how it has been moving in the market. So it's not direct advice on how you should be trading the markets, but hopefully it's something that you can find useful. If they, I'm pretty sure everyone would like to um, have close look on the US dollar. A lot of our currencies, especially, of course, the majors are marked against the US dollar. There are a lot of currencies that also follow the US economy and how it's moving and how the US dollar is moving. So this definitely, I hope, will be helpful for you guys. So if you have any questions along the way, you can feel free to put them into the comment section, be able to see them, and then we can address them as we go along. That's when you can see the questions coming in. I'll be able to address them there. Yep. So yeah, let's start with the fundamentals of the DXY. So the US dollars, as everyone should know, is the primary currency that's being used in the US, of course. It is the reserve currency of the world. It's very heavily traded. And here are some of the fundamentals, right, that influence the US dollar. So at the top of the list, and definitely one of the more important parts, definitely the influence of the Federal Reserve. So how the Federal Reserve moves, what they say, and the decision on interest rates and Fed fund rates definitely affects the attractiveness of the US dollar and holding the US dollar, for example. And that point sort of leads into the second pointer on interest rate differentials. So interest rate differentials, you just have to think about that in terms of the differential between the interest rates that are being offered in the US. So for proxy of that, you can look at the Fed funds rate versus another country. For example, if you're looking the sterling, for example, you would look at the BOE rates, and BOE has just cut on their latest session. So the interest rate differentials give you an idea of how we see, the how attractive the US dollar is against another currency. It also gives you an idea of the spot and forward markets and how they are traded in a perfect world, covered interest rate parity. There should be no opportunity for arbitrage, right, between interest rates because the interest rate differential is accounted for in the difference between the spot and the forward rates. But of course, we don't live in an absolutely perfect world. And there is some sort of basis that occurs, a cross currency basis that sort of violates the covered interest rate parity. But that is sort of a function of the inefficiencies, I guess you could say, of markets, right? So, but interest rate differential definitely still affects the trajectory of the US dollar. So in a sense, in a very simplistic way, if you think about US interest rates rising, then the US dollar can seem to be more attractive against another currency that on a basis on a ceteris paribus basis, interest rates doesn't move, and it could be more attractive for someone to hold US dollars. You hold US dollars, earn a US dollar equivalent interest rate in the United States, and as opposed to another currency. Very, very simplistic way of thinking about it, but that's one way of thinking about interest rate differentials. Thirdly, economic data is definitely important as well. So we know that there will always be regular releases of data that influences the Fed's movement on interest rates, influences the forward guidance for the Fed funds rates as well that's being posted by the FOMC. So you look at things typically like your non-farm payrolls, your CPI data, which is really important now. Given Trump's tariff plans that are expected to be a little more inflationary and could be more inflationary than what we had previously thought, given how volatile the new US president is in presenting his plans. That could be one contributor to inflation. Inflation has been quite sticky in the US, so that definitely contributes to how much leeway the Fed does have in cutting rates, and they don't want to be cutting rates too much to a certain extent where inflation starts to come back up again. It's the whole point of hiking rates in the first place, right? So that definitely affects another other releases of data as well, like PMI release, PMI data releases, payrolls releases, as I mentioned before, gives you an idea of generally how the US market, economy and the US market is doing. All right, and the last 2 points, geopolitical events, current market updates are sort of intertwined together. This gives you an idea of how the US economy is doing in general. So it could be the Black Swan events, it could be the events that everyone will be looking out for. So close to the end of last year, the event that everyone will be watching will be, of course, the US election. And now that that has surpassed, and everyone constantly is looking out for headlines related to the new US president or Trump and how he'll be laying out plans to push out tariffs, how that would have an impact on this protectionist policy. The general overarching consensus, the more protectionist the US becomes, is a boon for the US dollar, and not so much can be said for the rest of the world economy and for the US economy as well, and for US consumers particularly. But if you're just distilling it to the basic of how it can impact the US dollar, definitely could be a boon for US dollars. The US becomes more protectionist, becomes more absorbed into itself, and a lot of need for US dollar there, and more demand for the US dollar. And we'll also see this in the charts following the later months of 2024 and 2025. You see a little bit of a spike in the US dollar once it became clear that a Trump victory and a second Trump term came up. So yeah, that's a little bit on DXY fundamentals. And we'll talk a little bit about price action. I think if you're a regular attendee of webinars, you will be familiar with this, but we'll just talk a little bit about it because it's a very widely applied concepts that can be used here in technical analysis, right? So in terms of price action, you can use them to identify, for example, bullish trends, what you want to see, whether it's on a line chart or a candlestick chart. It's consistent higher highs and higher lows, and a consistent break of structures towards the high. You also, in the bearish downtrend, you also want to see the converse. So you want to see the successive lower lows, lower highs, consistent break of structure towards the lows. And in the event of a ranging market, you would see a very strong support, a very strong resistance. And you can think of it as strong floors and ceilings to price respectively. And price just sort of ping pongs in between them. It's not really moving anywhere, and that's why it's typically trend traders find it very annoying when markets move like this, because price is essentially not really moving anywhere. It's just moving sideways, right? So yeah, that's on price action, and I'll give you an idea of break of structure. We mentioned how break of structure does help us to identify bullish or bearish structures, right? And break of structures towards the high, bullish, and the other way, or bearish. But break of structures can also help you to see whether there could potentially be a shift in the market structure, right? Whether you think it has been bullish, but you suddenly see a break of structure towards the low, and you see very key supports being broken, and that could be a signal of a shift. Markets could be shifting in a certain way, and converse for a bearish setup. Suddenly you see a break of structure towards the high. You can also use it in a ranging market, and you see a price breakout above your very key support resistance levels. That can also indicate, and that helps you to get an idea of where the market structure is like. And it's also important with that to mark out your support and resistance levels, and that gives you a very clear visual cue, where the levels are at, where levels start to be broken, and where the market structure looks like. All right. So we'll move on to Fibonacci. So Fibonacci, if you really think about it simply, it's just to help you figure out where are the levels of strong support resistances. The idea behind it is the idea of mean reversion, that they are naturally set. Prices, tend to reverse to these levels, and that's why prices move in a certain way. You can also think of it in terms of institutional usage and retail investor sentiment. And the idea behind it is that many retail investors, many big institutions also use Fibonacci in their trading, and this results in big orders being set at these levels. So once you see price approach those levels, because of the orders that are set there and filled, once price arrives at those levels, that results in the reaction that you see in your price charts. And it's not so much just figuring out, these are the levels and it's probably going to react there. It's more of an having a sense of where it's more higher probability of seeing levels, seeing more orders at those levels, seeing a clear area of strong demand or supply that a big portion of the market will be watching out for. And then that's where you, at those levels, you expect to see strong reaction off of what resistance levels. So the idea behind that is horizontal lines likely to have support and resistance occur there, and which levels you use really depends on the trading style that you're used to. depends on, with experience of how you use Fibonacci levels, but these are some of the more common levels that are available. So with that, I'm going to pause for a little bit because we're going to move on to our trade setups. If you have any questions, you can drop it into the comment section while I move on to my charts. Just give me a moment. You don't see any questions. And yeah, let's continue with today's session. So as you can see, the US dollar, I'm just going to mark out one of those levels just now. So, with um, the movement in the US dollar, you can see as it came up to the end of 2024, with the new president being elected, you can see that there was a strong reaction of the US dollar towards the upside um, with these three consistent green candles, and it was just in January that there was seems to be a little bit of hesitation there. A candle with very long wicks, eventually a red candle, but you can see a very strong momentum towards the upside, and sort of a revival of the US dollar appeal and demand, given that the Fed at that point in time had been cutting rates. But with the return of a Republican White House, as well as the return of Donald Trump, who has promised a lot of tariffs, um, those are policies that a lot of people expect will be inflationary in nature and drive a lot of demand for the US dollar as a safe haven, as well as a reserve currency, as well as having more and more people will be having a need for the US dollar. That has sort of driven up the price of US dollar a little bit. Now it seems like price is sort of, excuse me, sort of retracing a little. So if you zoom down to the weeklies, it's a very similar story. You can see between somewhere over here, you've seen price just sort of moving sideways a little bit before breaking this very clearly breaking above this 106.5 resistance level over here. Okay. So with that, definitely does seem a little bit more bullish on the US dollar right now. But even on the daily, you can see that the price is really moving upwards. However, it seems like there is potential that there could be a deeper pullback for the US dollar. So that 106.5 levels, I'm just going to remove that because that was just a marker for you guys to see. Excuse me. So you can see on the weekly, it's very clear break towards the upside, and now it looks like price could be retracing a little bit. From here, you can actually start to use some of the Fibonacci levels, right? So if you're looking at a very deep retracement, you would look at 61.8% retracement, 78.6% retracement. These are very deep levels that price may be retracing towards. Or if you're looking at more shallow levels, the 38.2% level perhaps could be possible. And this is a little bit more in line with that 106.5 level that was the previous resistance that has been broken. So this is a key level I'll probably watch out for a little bit. It's a little bit more of a shallow retracement, but it is there. You can also use like an extension. So extensions are like sort of zigzag lines. So you're sort of projecting a zigzag move, where is it most likely for price to end up towards, and you can see that 61.8% extension is in line with that pullback resistance level at 106.5. So I'll just leave that there, although it is not very far off from where price is at right now. Maybe it's at around the 107.6 level as we enter into the European session. So yeah, that definitely is a key level to be watching out for. If you look on the daily, you can see that price is sort of hesitating a little bit. And why I would say that is if you draw a very steep trend line here, you can see that you could say that price has actually broken below the levels of this trend line. So you see it has been reacting off these levels once, not really much here, twice here, twice, and then price broke below this trend line, came back to test it, and it looks like it's showing a deeper retracement. So in terms of retracements, we could potentially see a deeper than possible retracement. So if it clears below this 106.5 level, I would say there could be a deeper retracement over here, possibly somewhere near the 61.8% or 78.6% retracement levels. Somewhere over here where there was previously some price action. This 106.5 level is definitely still an important one to watch out for. Just because of this, I'm a little bit more hesitant on taking longs of the US dollar and having, not really being sure whether price is going to sort of ping pong between these levels or really make a convincing break below the 106.5 and then test the lower support levels. Probably maybe somewhere near the 104 level or even lower below that. And that sort of matches up with the narrative that is available, that is available in terms of the fundamentals for the US dollar. So if you look at where Trump has been moving on tariffs, he has been saying one thing one day, moving in another. So he has been speaking about imposing tariffs on Canada, Mexico, 25%, 10%, and then now we're putting a stop and leaving room open for discussion. And it does sort of provide a little bit more volatility to the markets because you don't really know, where and when he could be moving on tariffs. And it does sort of seem like he's using tariffs as sort of a bully tactic, against most of the major trading partners that don't want to see these tariffs put in place. He's just using these big, numbers like 25%, 10% to sort of scare them into speaking the US and sort of complying to their needs. It appears that way, but certainly, with someone like Trump, you definitely see can definitely see him actually putting into place some of these intense tariffs, actually putting them in place, and then you would actually see the material effects on the economy from there. So it's very, very hard to sort of judge and to sort of decide on what could happen in the next days. That's why headline trading is sort of becoming a thing right now. And you're sort of just seeing people look at headlines and then trade based on that. But yeah, that's probably why there's a little bit more hesitation on the US dollar. You do know that with a Trump term, the possibility and probability of tariffs is higher. You just don't know, how intense they could be, and it really depends on the whims of the president that has introduced volatility to the markets. Could possibly introduce more volatility to the market, as you can see from where we are right now. So if you're looking at, for example, he seems to be very interested in imposing tariffs on the European Union. So you can take a look at the euro dollar. And you can see that the euro against the dollar has been showing a very consistent push towards the downside ever since November. Of course, a lot of this is also driven by the performance of the euro. The performance of the European Union's economy as opposed to the US economy that's been surprisingly resilient, even in the face of a very high interest rate environment. The euro, unfortunately, the European Union unfortunately hasn't been doing as well. Sort of major economies like Germany, France, Spain, which is why you've seen a very strong dip in the euro against the dollar. But another contributor to that is definitely the strength of the US dollar. That's why you're seeing the euro from near the last year where it was around 1.2, it has already dropped, dropped all the way down to 1.04 near those levels. If you look at the impact of interest rates, for example, against the sterling, where you've seen that move from the British, the BOE, again, very strong US dollar. That move for the BOE also has been a contributor, definitely not the only and the sole and main contributor to the weakness of the sterling against the US dollar, but one of them as well is the interest rate trajectory as opposed to the Fed been on hold. That could be one reason why we are consistently seeing US dollar holding its strength against most of the major currencies around the world. right? So I'm going to move back to the DXY. So those are the key levels I would probably watch out for in the US dollar. And yeah, we do still have a bit of time. If you have any questions, you can drop them into the comment section. Okay, I don't see any questions. That's all right. I do hope that this has been a useful session for you guys. I'm going to move that quickly to my charts. Sorry, to my slides. Yeah, so I do hope that the setups are useful for you guys. Again, on the dollar, my view on it is fairly mixed. In the long term, at least, in the next 3 to 5 years, it does seem like with US protectionist policies, very volatile present, could remain hard to say, but the general direction of it seems to be on an upward trajectory, more protectionist policies, inflationary policies that will probably stop the Fed or keep them from being able to cut rates as they expected, which probably introduces a higher base rate that contributes to tighter financial conditions that could drive demand for a safe haven like the dollar. It could also increase the attractiveness of the US dollar. So it does, in the long haul, at least seem to be um, from middle to long term perspective, seem like it's more bullish for the US dollar fundamental perspective, and definitely so on the technical. It's just um, on the short term, given how volatile the US president is on foreign trade policy, it's just very hard to tell, where he could be headed towards, right? So yeah, with that, we come to the end of today's session. Um, if you have any questions that perhaps come to your mind after the session, you can see this QR code on your screen that directs you to our feedback form. If you have any questions that come to your mind after the session that you'd like me to talk about in future sessions, you can leave it there. If you have anything that you'd like us to cover that we haven't already covered in our webinar sessions, you can also leave it there as well, and the Vantage team will be able to see it and will be able to relay it to us, and perhaps we can do a session in the future. Yeah, I hope that this session has been useful for you guys to help you understand a bit more about the dynamic behind the US dollar and a little bit about fundamental and technical analysis. Hope it's useful for you guys. And there are no further questions. Thank you again for joining me this afternoon, and I'll catch you guys in the next session.